SoundCloud. All right, Matthew, Natalia. Natalia's a first timer here. We are in episode 9, Wealth Wednesdays. I don't know if they're actually episodes, right? They're sessions and presentations, but we're calling them episodes because that's cool. Episode 9, and I think we got a bunch to talk about today. We're gonna do our market review like we normally do. Just talk about what's happening in the world, at least what we're aware of. And then we'll get into, presentation on some concepts that I think would be useful for financial advisors. Okay, so we'll be doing both those things. So Matt, have you noticed the the outright, I don't know, pessimism and distaste for investing and the stock market? Have you noticed that as of lately?
100% I have. I find if the stock market's doing good, people are happy. People want to put money in, which is not the time to put money in. And in times like this, very pessimistic. People are very unwilling to tell you what they have their investments in, and there's a lot of fear of upcoming recession and possibly a depression.
Right. A lot of fear for that, right?
Yep.
And
lots of fear.
I think always when we're trying to get that big picture market view, I think the best thing to pretty much look at is the S&P 500. And what I find very, very interesting, this is like a monthly chart on the S&P 500. So every bar here is 1 month. So this tracks quite a bit of data going back to 1980. So here we are on the monthly. Here we are with this, dynamic black line. That's our moving average, right? That's the 200 period moving average, Matt. And we typically just use that one when we're talking about these longer term picture type of ideas. And what I find crazy is that throughout this whole way down, advisors and clients alike, no one's really talking about investments. There's not a conversation of, hey, can I invest more? And financial advisors, I feel like, are not in that conversation of, hey, where are my investment clients? Or are there people to invest?
You might be right about that. I don't see it firsthand, but I find I don't know. I don't have as many people talking to me about investments.
Yeah.
People that I used to talk to about crypto are getting real silent. They're just
I'm using the crypto crowd as a gauge. I'm using my clients as a gauge. I'm using Facebook as a gauge.
Okay.
Right. So that's my experience. So as we've had this move down, the conversation for investments has been muted or has been lack. And throughout this whole move up, the conversation of investments was picking up again. And more people were confident talking about investments, looking to deploy, right? Looking to take action, looking to get responsible for their finances.
Yep. I'm thinking back to one of the first presentations we did about investing on your own, learning how to trade. And majority of traders quit in the first year. I think it was less than a year. And majority of them lose almost all of their money. And I see why. Because as the hype is building and things are doing good, that's probably when people are putting their money in. If they're talking to you and saying, hey, I hear this on the news, everything's up, they want to get in, but that's not the time. That's not the time to buy and acquire the assets.
It's the extreme optimism. Right?
Now we're seeing some extreme pessimism.
Yeah, exactly. So it's news heavy, extreme optimism, news heavy, call it extreme pessimism, and not even fully, right? I think there could be a little bit more, but not many people are looking to invest. So I think that's pretty interesting. People are looking for a larger correction, right? And a larger correction could look like the S&P 500 come even below the 200 period moving average like it did in 2020, right? And it's done it before in 2008. And all the big crashes, you've had like a breach of this 200 period moving average, right? Do I think we're going to get that? I have no idea. Do I think, for our clients, for us, we should be getting back into the conversation and addressing and talking about this 22%, 24% correction on the S&P 500, and start having those conversations saying, hey, like if you're interested in investing in 2020 or 2021 or 2019, now's a pretty good time. We're back to those prices, those levels, right? And I think that for the long run will be better than waiting to have that conversation when the S&P is back at all-time highs. So that's kind of what I think, right? I think there's an opportunity in investments, especially if people are thinking more long term. Definitely an opportunity there. Let's go look at the US bond market. Let's look at the yields, right? So Matt, we were talking off camera. Is Matt still on? Matt jumped off. All right, so Matt and I were talking off camera, and we were talking about like in financial planning, right? When we're working with our clients to ensure that we are planning for inflation and higher costs of living due to higher interest rates. I've had some clients say, hey, like, costs of living are going up through higher mortgage rates, right? So through a higher mortgage payment, right? Higher interest rates means higher mortgage payment. So let's, like, can I lower this insurance coverage or can I pause this insurance coverage? Or prospective clients who are thinking, yeah, I want that policy, $100 a month, that's fine. Month later, they have to renew a mortgage. And, now that $100 a month feels like a lot for them. Like it's a good chunk of their disposable income. Right? So one of the main factors that affects people's cost of living, which therefore affects their ability to purchase the plan you have to offer, is interest rates. Right? And interest rates specifically in the bond market. And not today, but the next Wealth Wednesday, so the week after next, we're gonna do like a deeper dive in the bond market, and we talk about it quite often. And we refer to it to get a gauge of what the market's doing, right? Because we've noticed that when yields tend to rise, right? So yields rise, markets tend to fall. Right? So if yields rise, markets tend to fall. What markets? Right? So stock markets, real estate markets. Okay. Lots of different type of markets. Okay, but right, even let's call it bond markets, right? When yields rise, the price of bonds come down. So as these yields rise, things like mortgages start becoming more expensive because now your interest payment on that mortgage tends to go up. And what investors and traders do is they focus or they pay attention to the interest rate on a 10-year bond, for example, in the United States. to have some indication if, hey, is my cost of living going to go up in the short term, or to get an indication on, the direction real estate could potentially take, or to get a direction on what stocks are going to do. And, if you're not an investor per se, you are a financial advisor. And as a financial advisor, it's going to help your planning if you can foresee or anticipate increased cost of living via higher interest rates. Okay. So that's what you could do. Now the question is, what do you do now? Or what could you do now? Right? And the question I'm always asking is, how high could these interest rates realistically go? It's probably a foolish question to ask because they could probably go up for perpetuity. Right? These interest rates, the yields, they could just keep going up. No one says that can't happen. Right? No one says it can't happen. Question is, will it happen? What I find super interesting is that this is the first time that we've been above 200 period moving average on the 10-year since this data goes back. And this data goes back to 1980. Hey, Matt, glad to have you back, brother.
Hey, Serge. Yeah, had a problem with the data out here. I am on the road. I'm in the car now. Doesn't look as nice as me being out in the sun, but it is what it is.
And you're good to go? Internet's solid, or at least feels better? Hello, Matt, you with us? Matt, do you want to turn off your camera, see if that helps? You back?
I think so. I think we're gonna drive somewhere else that's a little better.
All right, do you want to turn off your
Try to-
camera just to see if that helps or no?
Sure. I'll turn off the camera. You let me know if I'm freezing, you can't hear me. And maybe for the presentation, you can share your screen and do it on your end. And just in case I drop off.
Yeah, sure. Okay.
Okay. Awesome. All right. What are we looking at?
Yeah,
Bonds.
I was going off and I was sharing with people that how as financial planners, we don't maybe pay as much attention to inflation and increased cost of living through higher interest rates. And just telling, like, just sharing with the people that paying attention to bond markets, treasury bond markets, right?
Mhm.
They can typically give us an indicator of like things to come, right? So if you see yields on the 10-year going from 50 basis points to 100 basis points,
Mhm.
and that move takes about 3 months, 6 months to happen, you could expect that like a couple months or shortly after that you'll start seeing mortgage issuers starting adjusting the rates on their mortgages. And as if there's a projection for the central banks to continue increasing interest rates, then there might be projections for the 10-year or the yields on bonds, like the 2-year, the 5-year, the 10-year, the 20-year, to go up. And as those continue to go up, your mortgage rate or cost of borrowing essentially goes up and up and up. And when the cost of borrowing goes up, you have less disposable income. right? And the thing is, when people are looking to do their investment planning or their insurance planning, they are thinking, okay, how much disposable income do I have to put towards this? Right? So, paying attention to the bond market and the yields on these bonds, I think can help you plan a little bit better when you're doing your financial planning for your clients. Any thoughts there, Matt?
Where we see this in action is the housing market. I think when we see bonds, when we see interest rates are really low for borrowing, people are buying more and more expensive houses because that's what they can afford. And then when rates go up, housing prices come down, and it equals out to a monthly payment, which is what they can afford. We used to have 20-year mortgages. Now you see a lot of 30-year mortgages. Who knows? Maybe it'll be longer in the future, but that's seems to be an asset that everyone wants, and they're willing to do a lot to get there. So yeah, like you said, it comes down to disposable income.
Yeah. And then just tying that back to, let's say, Bitcoin or risk assets.
Yeah,
In anticipate. Yeah, sorry, Matt.
we see similar trends there as well,
Very
to a
similar.
different degree.
Very similar. Very similar. So again, back at 200 period moving average, this time on the weekly for Bitcoin, S&P 500 on the monthly, oversold. In anticipation for those higher yields, Bitcoin slowly came down. And before you knew it, it went from 65K to, I think the low was 17,600, right? Which took us back all the way to the 2017 all-time high, 2018 all-time high.
I remember that. I remember, oh my gosh, it's 20,000. That's crazy. And it went back down. And there
Right.
was all this bad news, and people were not muttering a word about Bitcoin for a while. So this stuff does happen. It happens
And
again.
and that's what's happening right now,
Mhm.
right? So this, just like this happened, distribution of this move up, that's what we're getting right now, right? We had a huge move to 65K from 3,000 to 69, 65,000 about a year and a half. So that's a lot, right? And now we're giving it back. And, if yields top out, so like I was actually sharing, I was getting into that if, how high could these yields actually go? And, if they're going to go to like 5, 6, 7, 8%, okay, yeah, Bitcoin can go much lower,
Mhm.
right? But let's go back to the 10-year real quick, actually. If you go back to the 10-year, we can see we're at levels that we've seen back in 2002 at one point. In terms of yields, we're 2022. So we're at a coupon payment in treasury yields that we've seen back in 2018, 2011, and 2003, 2002.
Mhm.
So my bet, if I were a betting man, I would say for the next 3 to 5 or next 2 years, 3 years, we're going to be mostly below this level than above this level. If I were to have to make a bet. And yields can come back down, back to these lows here before they continue higher or before they continue lower.
Mhm.
Right. So, I think when people are getting margin called and people got to reload their collateral and stuff and people are getting, liquidated, that's pretty much capitulation. And, if you're buying there, you'll probably do okay if you can wait for a while. You'll probably do good.
Mhm.
And that's the conversation you want to have with your clients around their investing, right? right? Long-term thinking. Okay, Matt,
Yeah.
it's we're just going over 20 minutes. I think we'll transition to the presentation, and I think
Yeah.
this was good. You know, just looking at the market, the state of it right now, the psychology of the market, sentiment, you know, interest rates and their impact on the consumer. And then, you know, how do we use that information to help with our financial planning or to add some more, I don't know, substance to our the advice that we give our clients, you know?
Yep. I think there's mistakes in the bond market, just like the stock market. And I don't hear people talking about it as much. There's not as much excitement there. So,
Right.
but yeah, let's switch over. If you could pull it up on your end in case I do drop off. The internet seems to be pretty stable right now. So, fingers crossed. We're going to be talking about some macroeconomics. So, let's go ahead and dive in.
Go for it.
All right, brother. So I want us to have a little bit of fun and just explore the fundamental theory. If you went and took any economics classes, this is all the basics that you probably have heard about, know a little bit about. This is going to be a refresher for some. This might be a whole lot of new material for other people. But these are sort of the fundamental basics in the large scale that we look at, not the nitty gritty. And this is always going to be present in the minds of anyone that is looking in the market, doing some investing. And we kind of threw it in there as well. Are taxes a way to help or hurt a free market? How does that play into account as well? So there'll be some theory that we're going to talk about. First three things that we're going to focus on are supply and demand, which we hear a whole lot, where I don't think most people can plot it on a graph or really explain the theory behind it. Competition, why competition is good for the consumer, and taxation, what taxation does to a market as well. All right, number one, supply and demand. Going under the looking glass here. Got it. So this is just a simple graph of supply and demand. As you can see, for supply coming from the producer, the higher the price, the higher the quantity that they want to produce. Whereas demand is opposing. It doesn't always have to be at this angle, but the higher the price, the fewer the quantity. And we see equilibrium in the middle. This is a perfect scenario with no taxation. That middle point where the lines
What do you mean by that?
cross.
What do you mean that's a perfect scenario with no taxation?
We'll look at it later. We'll look at what it looks like with taxation, but this is the market in equilibrium. So people sometimes think a company's going to want to make a price super duper high to make a lot of money. We get into, if they do that, they'll want to make more. Demand will be less. They'll make more money in total with a lower price selling more goods. Then we get into, you know, are there other companies involved? You know, is this a good that people could do without? Is there a substitute? Is this the only good available and the only company? Those are things that we're going to dive into today. Because for some people, a free market could be scary. What if we get taken advantage of by big corporations? And that's where the government has a lot of regulation. So without regulation, what would it look like? How would the market work? That's kind of what we're going to be looking at today. Do you have anything to say about the graph, Serge?
Let me go back. Well, I think, yeah, just to talk a little bit about this. Like, I think generally it's hard to find that equilibrium, right? Because what that means is like there is a perfect amount of supply to the demand, and it's the price, it's that perfect pricing with the perfect amount of quantity that would create that result, right? So that's what they call price equilibrium or market equilibrium, right?
Mhm.
That doesn't really always, that doesn't, like, that's not common. I don't know. I'm asking you, like, that's not common, is it?
When you have multiple companies producing the same thing, That's where you have competition. We're going to talk about that next. That's where you're not able to set the price and not lose customers. There's another aspect. If you have some company that maybe has a monopoly, like an energy company that can't be competed with, um, people need electricity no matter what. You're not going to see
It's like when they
demand
broke
go
up
down a
that
lot.
company. It's like when they broke up that company, Standard Oil.
They broke it up. I'm not familiar. What's the story there?
Well, there was a company called Standard Oil, and they broke it up into like a bunch of other companies because they said, "Hey, like these guys literally have like a monopoly on this whole thing."
Okay, wow. And who broke it up? Did the government get involved?
Yeah, some famous politician. I forget his name. This was
Interesting.
Rockefeller's company.
Oh wow. Okay, yeah.
Yeah,
Yeah,
this is
that's
Rockefeller's
a
company.
an interesting story. If you guys aren't familiar with was it John D. Rockefeller?
Yeah, and I guess
He
that ties into competition. The next slide.
Yep, he monopolized oil, but he was fair with the pricing, and then that company got carried down through generations. So that's always interesting if you want to read. So let's look at the competition now. Why competition is good? Good for the consumers. What's the difference between a monopoly, duopoly, oligarchy, which are words that we're probably used to hearing, mostly monopoly. Patents, how that ties into competition, and what it looks like, competition in action. Awesome. So here is just a breakdown. Competition is better for the consumer as the better value proposition will be rewarded over the others. I think when I think of capitalism and all these macroeconomic theories, it seems like just like the theory of gravity, like what happens out in the world naturally, we're just observing it. We don't have to move things around and create new structures. It makes a lot of sense and you can see it happen in real time. And on top of that, I mean, you have competition. I'm trying to think of some, Pepsi, Cola. There's a couple different, things we can look at.
Oh, I think we lost him there. Yeah, I don't know. I think competition, like what?
Then they
Oh, he doesn't know he's up. Can't hear you, Matt. You're cutting out. You're cutting out. You're cutting out. Cutting out. Well, yeah, I'm just thinking like what, piggybacking off what Matt is saying. Oh, oh,
Yep. How's my connection? Can you hear
we
me okay?
lost you. We lost you at Pepsi and Coca-Cola.
Got it. Got it. Yep. Value is subjective. What kind of phone do you have, Sergio?
I have an iPhone 10.
What How'd you get the iPhone?
I like Apple as the brand. I already had like most of my stuff with Apple, so it's easier. And yeah, I like the product. I had a good experience with it before.
Nice, nice. I got a OnePlus 8T. They're a company out of China and they competed with their first phone. This is the eighth one that they've come out with. And I know it was cheaper than the iPhone. I like Android's interface. I don't like the operating system for Apple. How much was your phone? How much did it cost?
I bought my phone cash deal
Yep,
at the time for like $750.
that's pretty good. That's pretty good. I know
At the
the
time, that was 2018.
2018. Okay, nice. 'Cause I know the iPhones are more expensive. I believe my phone was a little bit cheaper than that. This seemed like the value proposition. I'm not a fan of iPhone, so value is
Right,
very subjective.
right.
Uh, these phones are usually cheaper than iPhone, but iPhone gets a whole lot of business because if you want Apple, that's the only place you can go.
Right.
And
Well,
once you have it, it seems like that's what people get. You get the laptop too, and they have their own sort of ecosystem.
that's right.
So people have a different preference there.
But
Another
you
thing for
see,
competition.
it's because they
Oh,
have that ecosystem
yep.
that Apple is like worth more than a lot of those companies that you just mentioned. Well, you didn't mention any. Oh, I think you didn't even mention any companies. But if I'm thinking Android, okay, there's a bunch of companies that contribute to the Android ecosystem, and together, all those companies, yes, it's greater than Apple, but it's like all of them combining and work like building on top of Android or building on top of Android, right? Like so
Yep.
because Apple has a tighter grip on the competition, in my opinion, right? You can see a stock like Apple outperform other stocks where they don't have as much grip on the competition, right?
Mhm.
So I think if we're talking about investing, right? The reason why I was most confident in putting capital into Bitcoin versus other stuff is because I feel like Bitcoin has the least amount of competition. Therefore, I'm more confident to put money into that thing than I am to put money into like Compound or Aave or some other altcoin that has like a 500 other coins that are competing with it. You know what I mean?
Yep. And I mean, we look at Bitcoin, the dominance in the market for market cap is usually 40, low 40s%. So it's not majority, but it's bigger than all the other coins. Not all the other coins combined, but all the other coins individually. I'm sure if we looked at iPhone, it'd be the same. It'd be very similar to that.
And
Yeah.
Bitcoin got the Bitcoin is classified as a commodity. That's a big
Okay. Wow. Got it. Got
one.
it.
Okay, and that's from the regulators saying, okay, fine, it's a commodity.
Interesting. That's very interesting. Not a security
Which
or
so, so in the crypto world, it has less what competition.
Mhm. That's right. Awesome. All right. Let's go to the next slide here.
Yeah. What's this? What's this?
Competition continued. So I got some pictures of Monopoly on here. The board game we all like. The board game had another name. I'm trying to remember. Um, but the whole point of the game was to teach you that monopolies are not good, but it kind of became something where you just play with your friends and try to bankrupt them. But a monopoly, the definition is a dominant position, a company that has a dominant position of an industry or a sector. It's one company and it excludes all the other competitors. Um, I didn't have any examples in here, I don't believe, but we could probably name some. What would be a company that has a monopoly in a certain sector or industry?
Apple.
I wouldn't say Apple has monopoly. I mean, they have their rights to their software, which any company can have that. But it's not like
Okay.
they're the only company making computers. There's lots of companies that make computers. They just do it differently.
Okay. A company that has a monopoly. That's what you're asking me?
Toronto
Yep.
Hydro.
There we go. Here we
Oh,
go.
it says Toronto Hydro.
They have the infrastructure built. It's gonna be very difficult. I would put that as barrier to entry. They have done something that other people can't. You see, Bell owns a lot of the phone lines, and they let other companies use them. But they kind of have the monopoly there. They have the upper hand. They own what other people don't, and I'd say that's barrier to entry because anyone can say, you know what, we're going to start a hydroelectric company. Let's get a permit to put in the electric towers. Oh, we can't. Or
Right.
there's no room. Um, any other examples of that? I see Demetrios is on. Welcome, Demetrios.
Hi, guys.
Hello, hello.
Hey, brother, good to have you.
TTC.
There we go. Yeah, TTC. I know they partner up with the government. There might be some regulation there, but they have their stations built. I don't think they let any other company bring their trains in or anything like that. They have the what do they
You can
have?
start your own little bus company. You want it?
You can start a bus company. Could you do your subway company? Would you be
No.
able to use the infrastructure already there? Probably not, unless you got permission, right?
Right.
So that's where we have another monopoly. Duopoly, same
But like,
idea.
isn't that government? Like, aren't we talking now, not marketplace, we're talking government, you're talking public. These are, or are these private companies that, like, is Toronto Hydro a private company or?
Toronto Hydro is public, is a private entity.
Yeah.
TTC is a municipal or a public entity.
Gotcha.
But actually, TTC would be a duopoly because we do have a GO trains that still operate within the municipality of Toronto. Just they are mostly focused on the going out of the city, but still operate within the city. So I think GO and TTC would be the duopoly.
There we go. I know
Gotcha.
there's
Okay. You see,
Greyhound buses.
touche. Okay, I don't know these things.
I don't live in Toronto, so I'm not too familiar, but whenever I go, I see, TTC streetcars and whatnot. I see Greyhound buses in like Brampton because they're buses, but they don't have the
That's what I,
streetcars. They don't have the subways.
right.
Yeah. And then an oligarchy, a little bit different. Doesn't have to be just companies. A small group of people have a control of a country, organization, or institution. To me personally, this is scarier than a monopoly or a duopoly.
When you say a
this could
small
have-
group of people, like, don't you mean like companies? Like a small group of companies, like a group of companies having control?
doesn't have to be companies. A lot of times oligarchies work with the government.
Okay, Roger. Okay.
So I don't,
Gotcha.
I can't think of an example right now. Maybe we could look one up, but that's sort of the word that we don't hear a lot. That's sort of like maybe there's two companies working with government. You have someone in a municipal office get elected to a position, and now they're working with the companies there to
Right.
create this sort of structure to push out competition.
I would use a sports team, specifically European soccer teams. They're
Okay.
owned usually by oligarchies, and what they do is they send lobbyists to governments in modern, or not modern, in their local cities, whatever city they happen to own the club in, and they try to adjust laws locally that will allow them to do more business, because obviously the football club is not the only business venture. It's more like the face. So
Of a bunch of
people
other
love,
stuff.
yeah, like people love soccer down in Europe.
Mhm.
So if you buy a soccer team, people love you, right? Especially if you have a winning record. Now that takes all the attention off of what you're going to do with it, your actual businesses.
Right.
Yeah, in the context of market participants or organizations, the oligopoly would be telcos in Canada. Bell, Rogers, TELUS
Mhm.
monopolize the rest of the space and are not letting any competition in.
Yeah. So big. It's very big in telecom. We see the oligopolies. Where else?
Banking
Probably
system.
sports. Probably in the sport. You said Demetrius was saying sports, European soccer, banking. Yeah, probably banking. That makes sense too, right? For sure in banking. Yeah, it's a good one.
In certain countries, right? Like where it's
Right.
state and only certain people can, a certain status of people can, I guess, open a bank.
Right. All right, Matt.
Awesome. This is great.
All right, next slide.
Yeah, let's move on.
This drawing. How do I get off this text?
Can't answer that.
Patents.
There we go. Awesome. So patents, if you don't know, a patent is a type of intellectual property that gives its owner the legal right to exclude others from making, using, or selling an invention for a limited period of time in exchange for publishing and enabling disclosure of the invention. So there's a lot of times where companies will say patent pending. When they do come out with that pending, that gives them a little bit of security that their idea is not going to be stolen. And it's supposed to be used until they're able to bring it to market. then ideally the patents would end, but sometimes the patents kind of linger, and that excludes others from ever coming into that space. So that's sort of a barrier to entry that only exists because of the government, and they aren't universally recognized. A lot of times we'll have companies here in the US or in Canada come up with an idea, and it'll be registered with a patent office in the US. But then in China, the idea will be copied. Any other country overseas, Asian countries usually have that reputation. There's a bit of a stereotype there. You see it with motorcycles and different things. They'll remanufacture. Sometimes they'll buy the old plant that Honda motorcycles were built in, and they'll keep making a 15-year-old design, and they'll undercut the price and come out with a product, and that was patented, but they don't recognize the patent law in that country. So this is a way to sort of create something for yourself. Sergio, if you have an idea, you want to bring a new product to market, you're an inventor, and you don't have the money yet, trying to get investors, you're getting the word out. Maybe you're making a video online, you're thinking, oh, someone might steal this idea from me. I better get it patented to give me some security. That's where the idea is kind of.
Is that expensive?
That I don't know. That I'm not too sure. I don't imagine it being insanely expensive, but you would have to be thorough with it. If you've ever read patents, I've read
I
a
read
couple.
patents, man.
Sometimes, what's that?
No, that's not me. You've done that?
Yep.
Good for you. Good for
Bill
you.
Gates has some. I read some of Tesla's. We're going to talk about Tesla's patents in a minute. A lot of times they're just, I don't know, they look like scribblings. It's like, this is how it works. This is my idea. There's like graphs and whatnot, because it doesn't have to be a specific product. You see it with drugs, and there's protections for drug companies that have a specific chemical that they put together. Sometimes it's literally an idea. Like, we're going to put the car battery at the bottom of the car to keep the weight down so it handles nicer, lower center of gravity. That's what Tesla did. That was patented. But then Tesla did something interesting in their patents. Go on to the next slide. It's either the next one or the one after. Okay, here we go. So
Who's this guy?
Martin Scarelli, Dimitrios, you know who this guy is, right?
I'll take that as a yes.
Dimitrios, you there?
His face looks awfully familiar at the moment.
Got that. So he was CEO
Yes,
of
AIDS
Turing.
guy.
Yep, AIDS
Yes,
guy.
that's why his face. Sorry, I just can't forget a face like that. Just can't.
I got that. So in case you're not familiar with the story, Dimitrios knows exactly what I'm referring to. This lad bought the rights to Daraprim, antiparasitic drug used to treat infection that occurs in AIDS patients, malaria, cancer patients. Once he had control of it with Turing Pharmaceutical, is the name of the company, he raised the price from $13.50 to $7.50. And this is a product, obviously, if you're dependent on this and you need it, then you will buy it at any price. You'll find a way, insurance. So all of a sudden they're stuck. Oh, Serge, you
Sorry,
wanna go back?
I exited the presentation somehow.
Got it. Okay, no worries. This guy was all over the news at one point. He did get convicted. They were accusing him of breaking laws. Politicians were outraged. They were saying, "Oh, vote for me. I'll take care of this." And people immediately flocked to regulation. That's kind of what we're taught: is someone's doing something bad in the market, we have to create a law, we have to regulate it. And this got me thinking, like, this is why people give capitalism a bad name, is because, if you're making shirts, no one really cares. But if you're making life-saving medication, then that's usually where the government gets involved and says, okay, you can't do this price gouging. But then I started thinking, what if we didn't have these patents still? How old is this drug? This is not something new. I'm not a scientist at all. I don't understand the drug world, but I know you can make something similar chemically that takes some time. But there are lots of drugs where a brand name company will come out with it, and then generic companies will, like Apotex or any other company, will just make a copy of it, chemically the same, and sell it for a little cheaper. Why would a patent still exist? Why would he still have the ability to create a monopoly around this if it's already been on the market for so long? Theoretically, if that patent wasn't there, and it's not my say to be, it should be this long or that long, there's arguments on how long it should last, he would not be able to make money at 750. Consumers would remember what he did. If you're an AIDS patient, you'd hate this guy. And once another company would come out with the same product, you'd probably want to go there. And then there'd be a bit of a price war. So competition wouldn't allow this
Yeah,
sort
like
of thing.
who's paying this?
I'd have to go and read some articles. He said that people have a lot of insurance. They weren't actually paying the 750. It's very, very strange what happens in the States. They've had the price of insulin go up and down. We've seen the price of EpiPens shoot up like 3 times of what it was. There's a whole lot of stuff going on in the pharmaceutical space, and that makes a whole lot of people uncomfortable with the free market when they see that happening. But this was sort of a story of someone who said, you know what, I have the rights to this. They asked him why he did it. He said, to bring my shareholders profits. We're going to reinvest the profits. Like, that's why. And he got a whole lot of hate for it. Looking at the other side of the spectrum, Sergio, if you want to go to the next page. Elon Musk, Tesla. There's a whole lot of people talking about him right now with the Twitter deal. But he announced in 2014 that the patents would be opened up, sort of open source. And he completed, I say Tesla completed it. I know Elon was kind of heading this up. They completed that in 2019. And we see a whole lot of other electric car manufacturers using Tesla's ideas because Elon's letting them do it. There's a whole lot of ideas used in the Tesla cars that were patented that would push out competition from companies like GM and Ford. But Elon's kind of saying, you know what, that isn't the way to create this revolution of electric cars. And when I see that, that tells me that Elon's serious about a free market. He doesn't just say one thing and do another, like a lot of people in that world. But he's allowing things to actually progress. And I'm sure people will realize when they see the EV Hummer coming out, the fully electric Silverado, they'll kind of remember, Tesla did all this first, right? But we'll see what happens. Thought I'd share that. I thought that was pretty cool.
Super cool. And I could just imagine how many patents they have.
I believe it was quite a bit. I mean, it took 5 years to get all this done. There was a message released. If you just Google Elon or Tesla patents, you should be able to find something that was released on the website in 2014 of Elon saying what he wanted to do with the company. But now we'll switch over. We'll talk a little bit about taxes and the inefficiencies that they create in the market. Taxation is the only time that a consumer is going to pay more money for a good or service, and the money doesn't go to the producer. So producer does not get the money, but the consumer is paying more. That creates a deadweight loss and a market inefficiency. If we look at this map here, this is the sales tax in every province in Ontario. Being so used to Ontario, or sorry, every province in Canada, being so used to Ontario, we're used to paying 13%. Prices are almost always shown to us before tax, and then we end up paying a little bit more. We kind of get used to it. It wasn't until I went into Alberta and it was 5% tax. I was buying something to eat, like a burger, and I looked at the receipt and thinking, this doesn't seem right. This seems too cheap. Like, what happened here? Oh, wow. There's no provincial sales tax. It's just GST to the federal government. So the tax saving was quite insane. I mean, it's an 8% difference. And we become so used to it, we don't think about it. But with bigger purchases, it might have us buy a little bit more because our total budget is going to be saved a little bit there. So go ahead and skip over to the next slide there, Serge.
Ooh, what's this graph?
Yep. So this is what happens with a tax, a sales tax, is that it creates what's called a deadweight loss, and that's the tax revenue. As we know, the Canadian government gets its money through the tax revenue. So we have price equilibrium, but instead of being able to sell at price equilibrium, we are paying more and not getting the equal amount of goods back. So this is what it looks like graphed. And the bigger the taxation, the bigger the deadweight loss. We don't think about this a lot of times when we're participating in this. Every once in a while, you'll see people or you hear about people doing cash deals and going around the taxation, which maybe with a central bank digital currency, that'll be a lot harder to do. But that has us think like, would people actually buy more? Would it be good for the economy with less taxation? Theoretically, yes. Do we see that in action? I don't know. We'll get into the elastic and inelastic goods in a moment. But does anyone have any questions about this graph?
So what constitutes deadweight loss again?
Yep. So it's a market inefficiency is caused by the taxation. This is sort of shown as a sales tax, not like an income tax, which is dependent on how much you earn, not how much you spend. But we do see a unit tax here. So the price is higher without demand going up. And that deadweight loss is just the money that's not going into the market, it's going somewhere else. We accept that in society because the government's supposed to be investing those tax dollars and benefit everyone and sort of be worth it. Then there's arguments about what that looks like. I mean, 8% sales tax on everything in Ontario versus 0 in Alberta. How does Alberta make do with that? What are they doing different, right? There's a bit of interest in what goes on there. And you see that in gas as well. What's the price of gas right now in the GTA or in Ontario, Serge?
Man, I don't know. Last time I saw it was like 193 or something like that. 194.
193, 194.
$1.94 a liter.
Yep. Driving out to Alberta, we saw like in Northern Ontario, a lot of $2.12, $2.20 to get, just getting the gas up here. We were almost going to fill up for 220, and then we drove by Native, like a First Nations owned gas station, $1.85.
Yeah,
And I did the math. They're not charging HST.
that's why.
That's why. So do we buy more gas? No. We fill up what we could fill up. We're not buying gas tanks trying to get gas on sale. But that kind of ties into the next thing that we're going to talk about, which you'll see in a second. Even though the price is lower, we don't buy more. Real quick, yeah. So say you have a budget of $1,000. You want to buy something. Each unit of that good you're trying to buy is $100. Without any taxes, you can buy 10 units. Spend the full 1,000 and get 10 units, and the business on the other end is going to get $1,000 in revenue. With a 5% sales tax, like in Alberta, you'd only be able to afford 9 units. You'd be paying $945 because each unit costs quite a lot, which is 10%. You see a big gap. So now $55 are going unspent, even though you'd be willing to spend it. That $45 goes to the government, and now that business gets $900 in revenue. With a 13% sales tax, you'd be knocked down to only buying 8 units. You'd actually have $96 left over that you would be willing to spend. And you only get 8 units, and that business gets $800 in revenue. So in the real world, we kind of see it where there's a trade-off. We're funding the government instead of the business funding itself. We're buying less goods than we otherwise could afford. What does the government do with that money? That's a whole other thing. Maybe it's worthwhile. You don't mind doing it. But that's sort of what it looks like and how it hampers on the market.
Yeah, so you're buying less essentially.
Yep, you're buying less.
Because every time you buy something, you're contributing to the sales tax here.
That's right. That's right.
Which funds other stuff. Who knows, right?
Yeah,
Okay.
that's right. All right. Last topic we'll talk about, if you want to skip ahead another slide, elastic and inelastic goods. Elastic goods, you see demand fluctuate a lot based on price. You see a Corvette here. If the economy is doing good, people are making money, you know, Corvette's a whole lot cheaper than a McLaren or a Lamborghini. People buy them. You know, interest rates go up. Maybe people are buying a lot less Corvettes. You know, you're probably not the only car you own. You probably need a second car, more of a luxury than anything. Whereas on the totally opposite end of the spectrum, we have inelastic goods, gasoline. If you don't have a Tesla, you need to buy gas. Tomorrow, gas. If gas went up to $3 a liter, Sergio, would you still have to buy it?
I'd have to reevaluate a lot of my life.
maybe you'll buy a Tesla. There we go. Elon sees the price of oil. He's laughing. You might drive a little less. You might say, you know what, I'm gonna bike to the grocery store and try to balance all these grocery bags on the bike as I come back. Maybe get a different car. But for the most part, you're not really gonna buy less gas. We don't see a huge decrease in demand when price goes up like that. We're kind of at the helm of it. Go ahead and get to the next slide. You're gonna pay the gas. This is what the graph looks like for elasticity. So you're gonna see 0, infinity, -3, all these numbers. Look at the percentage of change in demand and the percentage of change in price. If the percentage is the exact same, then it has perfect elasticity, which would be unit elasticity, which is the green line, just 1-to-1. With gasoline, I'd say it's probably very inelastic or perfectly inelastic, probably very inelastic. If price, look at my mouse here, if price comes from here all the way up here, demand is not really going to drop much. Whereas with something very elastic, maybe a Corvette or you know, junk food that people like to eat when they're out and about at the carnival, price goes up a little bit and demand drops a whole lot. So when we're investing in the world at a time like now where interest rates are up, inflation is high, I think we're going to see a lot of these elastic goods drop in demand. But things like energy, gas, even banks are probably going to do very well. Those places that are still going to get business no matter what, the places that are perfectly inelastic or very inelastic.
Like grocery stores,
that's going to be a better place to invest. They might be cutting their profits a little bit, but they're not closing the doors.
Right.
Mm-hmm.
Alrighty.
Any questions about that? I know I'm
Oh.
kind of trying to zoom. We're getting close to 12 o'clock.
Well, it is 12 o'clock. We're trying to finish. We're trying to finish right at 12. Have you guys out of here? We know being on Zoom's tough sometimes. You know, you get that Zoom fatigue. But
That's right.
Matt, I think that was good. That was informative. You know, gives people to think. Gives I don't know, like, you know, you could think about these things in different ways and kind of make your own conclusions of how they apply to you and what you could do with this information, right? But I think it's very useful just to understand these market dynamics and, you know, like you went into not into the nitty gritty of taxes, but, you know, you did a quick overview there, and it's like now maybe people are going to be more interested in like, okay, yeah, what do my taxes pay for? Like, what is getting done with this money, right?
100%.
I think that's cool.
I agree.
Any final thoughts?
I agree.
Sorry?
Very informative. Thank you so much. I feel like I've done an overview of my economics university classes in one scoop. Very great. Thank you.
Awesome. I think it's good to keep in mind when we're investing and put it into reality. It's nice to have you here, Natalia. I like the contributions, and you're welcome to join us anytime.
Thank you.
Yeah. All right.
Awesome.
Have a good one, everybody.
All right.
Take care, guys. Thank you.
Take care.